In 1999, a woman named Geraldine Tyler bought a one-bedroom condominium in Minneapolis. She lived in it alone for more than 10 years. Then she got older, and her family moved her to a senior community. The condo sat there, hers paid for, and the tax bills kept coming. By 2015, she owed about $2,300 in property taxes, penalties, and interest brought it to $15,000. So the county seized the condominium, sold it for $40,000, and kept every dollar. The debt was $15,000. The county kept $40,000. She was 94 when the Supreme Court heard her case. All 9 justices sided with her. The Chief Justice wrote that a taxpayer must not lose more than she owes. Hold on to what that case says about owning a home in this country. Her mortgage was not the problem. There was no mortgage. The home was hers in full, and it was taken anyway for a tax that does not stop when the payments due. Her case is extreme. The complaint behind it is not. Listen to homeowners this week and you hear the same sentence in 100 forms. I closed on this house 30 years ago. I paid it off. I raised my family in it. So why am I paying more in property taxes now than I ever paid on the mortgage? Shouldn't it be mine by now? That question has an answer. It is written down, state by state, in tables most people never open. This episode opens them. Because right now, videos with millions of views are answering it with a different story, that Congress quietly changed property tax rules by age, that seniors are legally exempt and nobody told them, that states are cutting property taxes to zero. We pulled the documents behind every one of those claims. Most of them are folklore. And the documented version, the one sitting in court records, census tables, and state budgets, is worse than the folklore because it is true and it is mailed to your house every year. This is the relocation file, the 10 states where the tax on a paid-off home runs highest by the government's own count, what each of them actually offers a retiree, and which claims in your feed survive contact with the record. Every number on screen carries its source printed beside it in the moment it is spoken. Where a figure is an estimate, it says so, and every state gets its defense. First, the rule of the game, because it is never written on the bill. A property tax is the only major tax that ignores your income, ignores your mortgage, and ignores whether you have retired. It is levied on what your county says your home is worth. You do not owe it once. You owe it every year for as long as you own the home, and the county holds a lien on the house to guarantee it. Pay off the mortgage and the bank releases your home. The county never does. Miss the payments. And the machinery you saw in Minneapolis begins penalties, interest, a lien, a sale. Roughly $15 to $20 billion of property taxes go seriously delinquent in America every year, and a private industry exists to buy those debts and collect. How many homes are actually lost to it each year? Nobody publishes a national count. Remember that. Everything else in this file is counted to the dollar. The losing of the homes is the one number no agency keeps. So we ranked all 50 states by one number from one table. The Census Bureau's American Community Survey for 2024, the median annual real estate tax bill homeowners actually paid, half of each state's homeowners paid more than this number. Half paid less. For scale, the typical American homeowner's bill runs a little over $4,000 a year. The median in West Virginia is under $900. In the 10 states of this file, it runs from $4,700 to more than $9,000. One honest note on method before the countdown. A bill and a rate are different measurements. By the size of the bill, New Jersey is first. By the rate against home value, Illinois is, and when we reach Illinois, we will put that measurement on screen too, because leaving it out would flatter the ranking. Washington, the 600th median, is higher than our number 10, but it is not a state, so it sits in the description. 10 states. The bill, the machine behind it, what the state offers people over 65, and the fine print on those offers. The fine print is where retirements go to die. Number 10, Washington, median bill, $4,729 a year. Washington is the strange entry on this list because it is here without an income tax, no tax on wages, no tax on your pension, your Social Security, your retirement withdrawals. The state's constitution has been read for nearly a century to forbid a graduated income tax. The price of that arrangement is on your house. Part of every Washington bill is a statewide school levy, the legacy of a court order that forced the state to fund its schools, and the rest is local levies stacked underneath it. In 2025, lawmakers tried to loosen the one restraint in the system, the 1% annual cap on levy growth. The plan would have lifted it to 3%, roughly $800 million more from state property tax over 4 years, another billion for cities and counties. It collapsed in April under the governor's opposition. The cap survived this time. The bill to lift it will be back. Now, the relief in Washington's is real and actual exemption, not a loan, qualified by age and income, and part of the bill is simply gone. But the income ceilings are set county by county. In King County, the full program tops out at $84,000 of income. In the poorest counties, at about $40,000, and the county will not call you. Miss the form, pay the bill. There is even good news scheduled. Starting with the 2027 bills, the exemptions percentages rise for every tier. It is one of the few lines in this entire episode where the relief is getting bigger instead of smaller. Mark the date and file. The defense, no income tax is not folklore here. It is arithmetic that genuinely favors retirees with healthy pensions. Washington taxes the house you chose, not the income you live on. Whether that trade works depends entirely on which of the two you have more of. Number 9, Rhode Island, median bill $4,886. The smallest state just gave the country a live demonstration of how a city's failure becomes a homeowner's bill. Providence's school district went into state control, ran a deficit, and in late 2024, a court-supervised settlement ordered the city to pay $15 million toward it. The city had one place to find the money. The mayor proposed raising the city's total tax levy by 7.5%, above the 4% annual cap Rhode Island law allows, so the legislature had to grant special permission. It did. The final deal, struck in June 2025, raised the levy 5.85%, and it landed on freshly revalued homes. The city's 2024 revaluation put the average single-family home up 33%, from about $373,000 to nearly $495,000, with the steepest jumps in the neighborhoods that could least afford them, and steeper still on the triple-deckers, the multifamily houses that Working Providence actually lives in. Understand the sequence, because it is the whole episode in miniature. The school district failed under state management. A court ordered the city to pay. The legislature granted an exception to its own cap. The homeowners bill went up. At no point in that chain did anyone vote on the homeowners bill. It was simply where the chain ended. It is where the chain always ends. For seniors, Rhode Island has no statewide freeze. State law lets each of the 39 cities and towns freeze rates for residents over 65 if the local council chooses. A map of 39 different deals. The statewide backstop is a circuit breaker credit with a hard ceiling, household income under about $39,000, maximum credit $675 against a $5,000 bill. The defense. Rhode Island's numbers cluster tight. Few town lines doubled the bill. And when Providence failed, the state did step in rather than let the district collapse. The system worked. The homeowners paid for it to work. Number 8. Vermont. Median bill $5,026. Vermont runs an experiment no other state on this list runs. Schools are funded by a statewide education property tax. It began with a court ruling in the 90s that found rich towns and poor towns living under two different constitutions, and the fix pooled every town's school money into one state fund. Your school tax does not depend on whether your town is rich. It depends on what the whole state spends on schools. Fair, and it means there is nowhere to hide. When school costs jump, every homeowner in Vermont feels it in the same year, at the same time, in the same envelope. In 2024, that is exactly what happened. The average education property tax bill rose 13.8% in a single year, and that was after lawmakers spent one-time money to buy the increase down from a projected 18. The governor vetoed the tax bill. The legislature overrode him in June. The shock forced the biggest rewrite of Vermont school finance in a generation, signed July 2025, a per-pupil funding formula, district consolidation, new tax classes. Its changes phase in through 2028. Until they do, the bill stands. Now the defense. And Vermont's is the strongest fine print on this list. Most Vermont homesteads do not pay the sticker rate. Households earning up to about $115,000 pay education tax as a share of income instead, with a credit worth up to $8,000 applied straight to the bill. Vermont taxes property like a wealth tax and rebates it like an income tax. On a modest retirement income, the machine is far gentler than the median suggests if you file the homestead declaration every year on time. Number 7, California, median bill $5,369. California should not be on this list because California is where the tax revolt happened. Proposition 13, 1978, the general rate is capped at 1% of what you paid for the house. The assessment can rise at most 2% a year, less if inflation is lower. It resets only when the home sells. So why is the median bill $5,300? 2 reasons. First, prices. 1% of a California house is real money the day you buy it. A $1 million purchase, which in much of coastal California is a starter home, is a $10,000 bill in year 1, locked to that purchase price forever. Second, the base rate is not the whole bill. Voter-approved bonds, parcel taxes, and mellow roost district charges stack on top, commonly $1,000 to $6,000 a year in newer developments, and those are flat charges per parcel that do not care what you earn or what the house is worth. The famous 1% is a floor with an elevator on it. You may also have seen the story that California is ending property taxes for homeowners over 60. Here is its actual status. A citizens' initiative cleared in February 2026 to gather signatures, nearly 900,000 of them required. As this episode is being made, it is not qualified for any ballot. The state's own analyst prices it at $12 to $20 billion a year out of schools and local government if it ever passes. The defense is the strongest on the list. For the people, Proposition 13 protects it, works exactly as promised. Hold a California house 30 years and your assessment barely moves, while the new buyer next door pays 4 times your tax. That is also the trap. The tax system itself now pays Californians not to move and charges newcomers for the privilege. The bill on this list lands on whoever arrived last. Number 6, Illinois, median bill $5,399. And here is the promised second measurement. By bill, Illinois is sixth. By rate against home value, Illinois is first in the nation, $17.93 per $1,000 of value, double the national rate. Second year running at number one. A high rate on a modest house is a different disease than a high bill on an expensive one. In much of Illinois, the houses are ordinary and the tax is not, so the tax quietly eats the asset. You pay coastal money and taxes on a house that will never sell for coastal money. And the burden does not land evenly. In 2024, when Cook County reassessed its south suburbs, the median residential bill there jumped nearly 20% in 1 year, the largest recorded increase in at least 29 years. In the village of Dixmoor, the median bill more than doubled. In the village of Phoenix, Illinois, it doubled too. 13 of the 15 hardest hit suburbs are majority black. The county's total take that year rose by about $700 million, and homeowners, not businesses, absorbed roughly 86 cents of every new dollar. That is what a rate this high does when commercial values wobble. The house is the payer of last resort because the house cannot leave. Illinois relief on paper, seniors under $65,000 of household income can freeze their assessment. Read the fine print, it freezes the assessed value, not the bill. Rates can still climb on top of a frozen assessment, and they do. And the freeze must be reapplied for every single year. Forget once, and it resets. There is also a deferral. The state pays up to $7,500 of your bill each year, files a lien on your deed, and charges 3% annual interest until you sell or die. The rate used to be 6. Cutting it to 3 was announced as relief. A cheaper lien is still a lien. The defense. Illinois is one of very few states that taxes no retirement income at all. No tax on Social Security, pensions, or retirement withdrawals. Illinois taxes the house instead of the pension and says so plainly. If you rent in retirement, Illinois is quietly one of the better tax deals in America. If you own, you are the deal. Number 5, Massachusetts. Median bill, $6,080. Massachusetts had its own tax revolt, Proposition 2.5, 1980, and it holds 45 years on. 2 caps, actually. Town's levy can never exceed 2.5% of the value of everything in town, and it may grow no more than 2.5% a year plus new construction, unless the voters themselves approve an override, which wealthy towns do routinely, and stretch towns cannot. But read carefully what is capped. The town's total, not your bill. Your bill can rise far faster than 2.5% in any year the burden shifts toward houses like yours. And in Boston, the burden just shifted. Boston just demonstrated the mechanism in public over 2 years. Downtown office values fell, remote work emptied the towers, and offices pay a large share of Boston's levy. So the mayor asked the legislature for temporary permission to lean harder on commercial property to spare homeowners the difference. The city council passed it. The state house passed it. The state senate blocked it twice without ever taking a vote. In December 2025, the city set its rates. The effective residential levy rose about 13% in a year. The office towers problem became the bungalows bill, exactly as the mayor had warned, and exactly as the cap allowed, because the cap guards the town's total, and the total simply changed hands. The defense is one of the best designed relief programs in the country. The senior circuit breaker. If property tax eats more than 10% of your income, Massachusetts mails you the difference as a refundable credit up to $2,730. Renters can claim it too against a quarter of their rent. It is real money. It arrives as cash, and it requires nothing but filing a state return. The limitation is the cap. Against a $6,000 median bill, it is a break, not a rescue. Number 4, New York. Median bill, $6,542. That statewide number hides what New York actually contains: the most expensive property tax counties in the United States: Nassau, Westchester, Rockland, Suffolk. In several of them, the median bill is so high the census survey does not report the number. It simply records over $10,000. The survey scale tops out below what half the homeowners in those counties actually pay. 3 of the 5 most expensive counties in America are New York suburbs, which is why this state produces the sentence you hear at every Long Island kitchen table: the property taxes are a second mortgage that never amortizes. On a $15,000 bill, a retiree needs to clear more than $1,200 a month after tax from a fixed income, before heat, before insurance, before food, for a house that has no loan on it. Outside New York City, levy growth has been capped since 2012 at 2% or inflation, whichever is less. The cap is real, and it has held. It also started to clock at the highest baseline in the nation. A 2% cap on a $15,000 Long Island bill is still $300 more a year, every year. New York's answer is the biggest relief machine in America: the STAR program, which pays part of the school tax for nearly every homeowner in the state. The basic version reaches households up to $500,000 of income. Seniors get the enhanced version, but watch the cliff. Its income limit is $110,750, recalculated each year, $1 over the line, and the enhanced benefit is gone entirely. The defense: those bills buy the school systems that hold those home values up. A Long Island tax bill is private school tuition collected by the county, whether or not you still have a child in the building. The counties on this list are among the very few in America where the house's value grows faster than the tax that guards it. It is a defensible deal for as long as you can float it on a fixed income. Number 3, Connecticut. Median bill, $6,573. Connecticut does something none of the other 9 does. It taxes the car in your driveway as property every year through the same machinery that taxes the house. There is a cap, 32.46 mils, which lawmakers had to impose because some cities were taxing a family sedan at nearly twice that. The deeper story is what revaluation is doing statewide. Connecticut towns revalue on a rolling schedule, and the current cycle is landing on a market that repriced violently. In the towns revalued in 2024, assessments rose about 34% on average. In New Haven's last cycle, one working-class neighborhood's residential values rose 69%. The city phased the increase, so the bills arrived in stages, like a sentence served in installments. Bridgeport, the state's biggest city, revalues this cycle. Its homeowners find out next. And Hartford runs the strangest ledger in New England. To keep a poor city's homeowners housed, residences there are assessed at about half the ratio the law sets for everything else, while commercial property pays one of the highest effective rates in America. It works barely, and it means the capital city's tax base is a balancing act nobody dares touch. For seniors, Connecticut runs one of the oldest circuit breakers in the country. Automatic ones granted up to $1,250 for a couple. The income ceiling, $56,500. Above that, the state's answer is the car cap and patience. The defense: Connecticut is simply an expensive state, being honest about it, and its restraint on vehicle taxes was a real recent act of mercy. But it is the only state on this list where the tax follows you into the driveway. Number 2, New Hampshire, median bill $6,707. New Hampshire is the control experiment for this entire episode. No income tax, and since January 2025, not even the old tax on interest and dividends. No sales tax, state or local. The only state in America with neither. And it has the second highest property tax bill in the nation, because schools, police, fire, and plows are paid from somewhere. And in New Hampshire, somewhere is your house. Over 60% of all state and local tax revenue here is property tax, the highest share in America. In 2025, the arrangement met the courts. In June, the state Supreme Court upheld the statewide education property taxes administered. 9 days later, the same court affirmed that the state's base school funding, about $4,100 per pupil, is unconstitutionally low and blessed a floor of $7,356. And in August, the trial judge ruled the wildly unequal local school tax rates violate the state constitution. 3 rulings, 1 message: the bill is not done growing. Relief is town by town. Each of the state's municipalities writes its own elderly exemption with its own age bands, income limits, and asset tests. In Manchester, a homeowner over 80 can knock $280,000 off the assessment. At 65, 156. Drive 20 minutes, and the same person qualifies for a fraction of that or nothing at all. Your relief depends on your zip code's generosity, voted at town meeting. If you keep one mechanism from this file, keep this one. A state that refuses to tax income has not lowered your taxes. It has moved them onto the one asset you cannot hide, cannot move, and after retirement cannot out-earn. We documented all 9 no-income tax states in another episode. The pattern held in every one. The defense: New Hampshire's deal is at least transparent, and for high earners, it is the best deal in the Northeast. The whole point is that you keep your income. The people for whom the arrangement quietly inverts are the ones living on fixed incomes in appreciating houses, which is a precise description of a retiree. Number 1, New Jersey, median bill, $9,358 a year. It is not close. The gap between New Jersey and second place is bigger than the entire median bill in 20 other states. And the median undersells it. The average residential bill crossed $10,000 for the first time in 2024 and hit a record $10,570 in 2025. In 18 towns, the average is over $20,000. In Millburn, 26. Do the arithmetic, no mailer ever prints. At the current median, 30 years of ownership bills over $280,000 before a single increase. A second house paid to the county on the house you already paid off. New Jersey knows no state has more relief programs on its books, and they are real. Senior freeze reimburses longtime owners for every dollar their bill rises above the year they locked in if household income stays under about $172,000. The anchor rebate mails most homeowners up to $1,500 plus a senior bonus. One application now covers all of it. And then there is Stingy. The 2023 promised to cut every senior's property tax bill in half, up to $6,500 a year. The boldest property tax promise any state has made this century. Here is what happened to that promise, and it happened 5 weeks ago. The first stage checks go out this August and November. And in the budget signed on June 30th, the income ceiling was cut from $500,000 to $200,000, and the full $6,500 benefit was reserved for incomes under $100,000, $5,000 and $4,000 for the tiers above. Renters excluded entirely. Read that timeline again. The program shrank between its enactment and its very first payment. Relief in New Jersey is not a right, it is a line item, renegotiated every June, and this June it lost. to defense, and New Jersey has earned one. This is the most serious relief effort in the country, funded with real money, reaching real people. The freeze alone protects longtime owners from exactly the revaluation shocks that hit Providence and Cook County. And the bills by the most consistently top-ranked public schools in America. New Jersey is not hiding the price of anything. It simply is the price. Now the feed, 3 claims, millions of views between them, each one checked against the primary document. This is the chapter the algorithm never rewards, and the record always does. Claim 1, Congress changed property tax rules by age. 300,000 views in a day this week. The record, Congress levies no property tax and passed no property tax rule of any kind. What Congress actually passed in 2025 is a temporary income tax deduction for people over 65, up to $6,000, 12 for a couple, shrinking above $75,000 of income, gone entirely after 2028. It does not touch your county's bill by 1 cent. Claim 2, states are cutting property taxes to zero. The record, exactly 1 state has put elimination in front of its voters, North Dakota, in November 2024. It failed, 63% to 37%, and all 53 counties voted no. Florida's amendment on this November's ballot is real, and it expands an exemption. It eliminates nothing, and Florida's own revenue estimators price it at $12 billion a year. Claim 3, seniors are legally exempt, and most don't know. The record, no state exempts all seniors from property tax, not one. What the fine print usually offers is a deferral. The state pays the bill, files a lien on your deed, and charges interest until the house is sold or you are gone. Texas charges 5% a year for the privilege. Oregon, 6. That is not an exemption. It is a reverse mortgage where the lender is your government. And one more thing the record shows, quietly, since the Tyler ruling you saw at the start, when Geraldine Tyler won, about a dozen states still allowed a county to keep the surplus from a seized home, the practice the litigators called home equity theft. 3 years later, every one of those states has rewritten its law. The last state in the country to stop keeping the change was Illinois. It signed its fix 5 weeks ago, 3 full years after a unanimous Supreme Court. And only after Illinois homeowners had reportedly lost more than $300 million in equity, an average of 85% of everything they had in the house. One more number from that file. Among the documented cases that started this movement was a home taken over a debt of $8.41. That case is why the word theft stopped being a metaphor in the court filings. Every one of those viral claims would have made this episode easier to sell. All of them died against the record. What the record shows instead is harder and quieter. A tax that outlives the mortgage, relief that is often a loan, and a 94-year-old who had to take her county to the Supreme Court to get back the difference. So what do you do with this file? 3 things the record supports. First, the bill is knowable before you move. Every number in this episode came from a public table, the Census Bureau's American Community Survey, Table B 25103, free, online, covering every state and every county in America. 10 minutes with that table before a move is worth more than every relocation video ever made, including this one. The table number is in the description. Second, if you are over 65 in any of these 10 states, there is a form with your name on it, a freeze, a credit, an exemption. Not one county in this episode calls its residents to offer it. File anyway. This year. Third, read whether the relief is a gift or a lien. Half of what is marketed as relief is a loan against your heirs at interest in writing. And the counterweight, one last time, these 10 states are not scams. They contain most of the best funded schools, the fastest fire departments, and the most durable home values in the country. The tax is the price of the place. The scandal is not that the price exists. It is how it lands on the people who already paid for their houses and how much of the printed relief never reaches them. One more honest sentence about this list itself. Ranked by rate instead of bill, the order changes. You saw Illinois jump from 6th to 1st. Ranked by tax as a share of income, it changes again. We chose the bill because the bill is what arrives in the mailbox, but no single table is the whole truth, and anyone selling you one number is selling. Next time in the file, the other end of the same table, the states where the bill runs under $1,500 a year, and what the record says you give up to get it. Where to live, where not to, every number sourced. This is the Relocation File.